This video continues our last video, and going down along the notes, we are now up to the asset inventory. And again, what does a manager need to know about the accounting for inventory? I'm not going to talk about the debits and credits, and I'm not going to talk about the valuation methods. Remember FIFO, LIFO, and weighted average. If you've taken a financial accounting class as an undergraduate, we're not going to get into that, but we're going to stay bigger picture here. When a company purchases inventory, what happens to the balance sheet and the income statement? Well, nothing happens to the income statement because the company is simply exchanging one asset cash for another asset inventory, or perhaps it's buying it on account. Regardless, inventory, a current asset, obviously increases, and then the other side of that transaction, either the current asset cash decreases or the company promises to pay for that inventory in the future. We would call that accounts payable. So either the asset cash goes down or accounts payable, the liability, current liability, would increase. How do I know that it would be a current liability? Just like accounts receivable, is the company offering the customer the right to pay later without interest. Accounts payable, now it's the company taking advantage of this interest-free loan. So typically it's going to be quite short term because the seller wants to get their cash rather quickly. One thing to notice here, as I said before, no expense is recorded, so the income statement is not affected. All we did was increase the asset inventory with either a decrease in cash or an increase in the liability. Now, what happens when the company sells the inventory? The company sells the inventory, four things happen. One, clearly, most obviously, sales revenue increases on that income statement. Related to the sales revenue going up, either the company receives cash, the current asset cash, from a customer. And if the company does not receive cash from the customer, the company receives a promise to get that cash from the customer. So another current asset, accounts receivable, would go up. But that's not all. When the company sells the inventory, it no longer has that inventory. So I'm going to write the inventory here next to the asset side. Here is going to be 1 and 2, 1 and 3 are going to show the income statement impact. 2 and 4 are going to show the balance sheet impact. So the company no longer has that inventory. Who has it? The customer has it. So inventory, the current asset inventory, is going to decrease. What's the other side of this transaction? Well, we recorded revenue. We need to also record an expense. And that specific expense that says what was the cost of that revenue to the company is called cost of goods sold. So this expense increases. And presumably your sales revenue, your price for the goods, is significantly higher than your cost of the goods. And that difference we would call the gross profit, is what remains for the company. Let's go to just a few examples before we continue on our inventory management. Assume Kohl's purchases 100 pairs of Adidas sneakers for $40 each. Kohl's pays cash to Adidas. What happens to the balance sheet and the income statement? Cash decreases by 4,000. Inventory increases by 4,000. And nothing happens to the income statement because nothing has been sold. Remember, one is revenue recorded when goods or services have been provided to a customer. That has not happened yet. The next day, Kohl's sells all 100 pairs of sneakers for $70 each. The customers pay cash. What happens to the balance sheet and the income statement? Cash increases by 7,000, cash received from the customers. Revenue increases by 7,000. We just sold goods to customers. Inventory, the asset inventory, decreases by the cost, not the selling price of that inventory. And cost of goods sold and expense increases by 4,000. So increasing the expense reduces the net income. Income went up by 7,000 and down by 4,000, so we see that gross profit on the sale was 3,000. Okay, a few true-false questions before we return to the notes. When a company purchases inventory, net income decreases. True or false? That is false. The expense is recorded once the inventory is sold. When a company purchases inventory for cash, current assets increase. True or false? False. One current asset inventory increases and the other current asset cash decreases. When a company purchases inventory on credit, current assets increase. True or false? True. Inventory, a current asset increases. And what is that other side of that transaction? Liabilities, or specifically accounts payable, increases. When a company sells inventory, expenses increase. True or false? That's true. The specific expense is called cost of goods sold. When a company sells inventory, gross profit typically increases. True or false? True. When the sale is recorded, the revenue increases and cost of goods sold, the expense increases by a lesser amount, and that difference between revenue and cost of goods sold is called gross profit. When a company sells inventory, current assets typically increase. True or false? True. When the sale is recorded, inventory decreases at the cost of the inventory, and cash or accounts receivable increases by the selling price of that inventory. Inventory management. If inventory levels are too high, what might happen? Well, several things. There's several risks of holding too much inventory. One is that cash is tied up. The company has to spend money to get that inventory, and that cash could have been used for possibly other more productive purposes. Of course, we have the risk of those goods going out of style or becoming obsolete. So the risk of obsolescence. A good example of this is Dell, which actually waits till it receives a customer's order before it puts together the inventory, so it's not going to carry any finished goods inventory. And finally, there also may be storage costs. If you have too much inventory, you have to store it and protect it. So we should keep very, very low amounts of inventory on hand, correct? Well, it depends. If we know we can fill sales with, like Dell does, with very low cost of finished goods inventory, we can. But we also have to be aware of the risk that if levels are too low, our customers come in, don't find what they want, and we could lose sales. And what are the ratios we're going to look at for inventory? Two ratios very similar to the accounts receivable ratios we looked at. We're going to look at inventory turnover and days in inventory. How quickly is our inventory turning over or getting sold? And how many days? Let's estimate how many days our inventory is just sitting on the shelves of the company. So whereas with sales drive accounts receivable, but we don't want to compare our sales to our inventory. And the reason is the sales includes the markup, right? Our cost, we want to compare the cost of the inventory to the actual inventory levels. So we're going to compare cost of goods sold to average inventory. And clearly the more we're turning over the inventory, the more we're earning our gross profit. So of course higher is better. And days in inventory is a similar equation to our days in receivables. We're going to take 365, the number of days included in our cost of goods sold. Here we're looking only, in this class we're looking only at annual financial information. 365 divided by the inventory turnover. And of course, in this case, if we're looking at, we don't want to have our inventory sitting around for too long. We talked about the risks of that. So clearly lower is better. All right, in the next video, we're going to look at long-term assets, plant, property, and equipment, and intangible assets.